It's Monday morning, 8 a.m. Mountain Time, 10 a.m. back east. This is Barry Knapp with Ironside's Macroeconomics. Our note this week was titled Tightening Financial Conditions. We started out with a title about the changing narrative around the bond market bear steepening, but that's really what it represents is a tightening of financial conditions. And so that's the title we eventually went with. There were, I guess we'd call it 5 sections to the note this week. The first one we titled Disorderly Disinversion, and about the comings and goings in the Treasury market and mortgage market for that matter, and implications for the economy and what was driving that, a little bit of a dissection of the causation. We then went on to talk about rate sensitivity. That's the chart I sent around associated with the email associated with this audio summary of the note. And that you can see from the chart, we've got the duration of the Barclays Corporate Ag Index, the MBS index, and then the high yield index. And what you see is duration in the corporate index is quite long. Duration in the MBS index has never been longer, underscoring the lack of rate sensitivity in the large non-financial corporate sector and household sectors. But then duration in the high yield index shrinking towards low levels it was at back in 2019. And that's an illustration of our unstable equilibrium where the household sector is fairly immunized to higher rates. The non-financial corporate sector is as well. But banks, small businesses, highly leveraged enterprises are starting to struggle with the tightening credit channel. And that's why we illustrated it using these bond indices, modified duration. We then had a section titled The Petrodollar Doom Loop. It's a lot about the interplay of oil, currencies, and the Treasury market, and ultimately the banking system. We then provided a little bit of a preview of Jackson Hole this week. And by the way, we may end up releasing our note late rather than Saturday morning because there won't be Jackson Hole speeches until Saturday. We may not release the note until Sunday or even Monday morning. After we've had an opportunity to go through all the Jackson Hole papers. We know the chairman's speech gets most of the attention in the markets, but we really like to dig into those speeches. For example, back in 2018, there was a series of speeches about market concentration in big technology companies and pharmaceutical companies, a range of industries, which really foreshadowed the Cantor change in antitrust policy in this country. And that was that academic support for it and how that's built into something that became impactful over time. And so for us, digging into those papers is always interesting and often does foreshadow future events and changes in policy direction. And then we wrapped up the note with a section titled Over. Did you say the risk off episode is over? And as of this morning, S&Ps are trying to bounce, but the bond market is back under pressure. It's bear steepening led by the real rate part of the curve. So for us, as long as this is persisting, can't see equities really putting together a decent bounce. So on the disorderly disinversion, the markets are starting to hit our targets. 10s are decisively through, nominal 10s that is, through 4.25. Real 10s got to 2% this morning. The S&P's down between 5 and 7%, 5.5 roughly, which was our target. We don't think this is really about growth. That's how the narrative started to change last week. And we went through the data that came out and the New York Fed's weekly economic index. And that is not really getting all that much stronger. Sure, it was a decent retail sales number, but we also had a very weak National Association of Home Builders housing index, and we don't believe that's really been what real rates have driven real rates going all the way back to the conundrum in 2004 and 2006. real rates are much more driven by policy, now asset purchases, expectations for future rate cuts. That is related to growth, to be sure, but really, this is more about supply and demand. And Janet Yellen losing her best customers as she has just 500 billion extra of coupon securities for sale this fall, and that we think is the real driver here. And we have some catalysts for turning that outlook around. Kansas City Fed Symposium, Jackson Hole, starting on Friday. And then next week's labor market data we think is going to be really important. As a side note, we are going to get the first look at the benchmark revision for payrolls on Wednesday. That could be quite interesting. We've been going through the business employment dynamics report, for example, we wrote about a few weeks ago, and how that foreshadowed a big reduction in that benchmark, or a big downward revision to the benchmark revision, because we think the birth death model is getting small business employment totally wrong. But anyway, that'll come out on Wednesday, and we'll at least put out something on the Substack chat about that. So moving on to rate sensitivity, again, this bond market indices modified duration really does illustrate that point. Retail sales numbers last week were definitely better than expected, but we think what that really may very well be portending, more than a change in the level of consumption, is that rebalancing between goods and services might finally be largely complete. Goods consumption is running about 75 billion below trend that we trace back to mid-14, when the household deleveraging related to the financial crisis in essence ran its course. Service spending is some 30 or 40 billion above trend. So we may just have hit that point. Remember, retail sales is mostly goods consumption, and it only represents 20% of total personal consumption expenditures. The pundits got really carried away with what the Atlanta Fed GDP Now tracker said. There's no doubt that July was a decent month, but we're 1 month through a 3-month quarter. We would definitely fade that 5.8% GDP Now tracker. We don't think we're going to be anywhere near that when all is said and done. But nonetheless, that it does, what's happening with the household sector is that it is largely immunized from rate hikes, and they really haven't begun to bite in any meaningful way yet. We also went into credit a little bit, though, to look at some of the weaker sectors. Right after a CNBC appearance we had last week was a real estate guy, Scott Reckler from RXR, and he was talking about the real risk in the small banking system is not so much office buildings, but multifamily housing. There is a lot of work people are putting out there about the amount of supply that's coming into the market and how that sector has been largely financed by small banks. So it's another area to keep your eye on. And we had a chart in the weekly showing credit spreads in that sector. We'll be following that closely from this point. So moving on to what we're calling the petrodollar doom loop. Remember, bank securities portfolios are back under pressure with the Treasury market, hitting these new highs in yield. And so if that is still the case in 6 weeks' time when the quarter ends, there's going to be a lot of focus on that. Sure, a lot of bonds are held in held-to-maturity accounts. They don't need to be marked to the market, but everyone's going to be quite aware of what those portfolios look like. Deposit pressure still looks quite acute from our perspective. Money market fund flows are very strong. Small bank deposits are going up a little bit. Large bank deposits are going down. But to us, that's an indication that small banks are paying up, which means net interest expenses rising more quickly than net interest income, and there'll be additional pressure there. We started to dig into credit in the note, showing how securities holdings are down some 11 and change percent year on year. C&I lending has turned negative. Overall bank credit is negative. Resi loans are still up. Consumer loans are still up. Again, back to that same point about our unstable equilibrium. But that part of the system that is funded by small banks, meaning small businesses and a lot of these, real estate sectors like multifamily and office buildings are going to be under increasing pressure. Now, at the same time, part of what we think really triggered the pressure in the rates market last week was the rise in crude. Given that the dollar is now, in essence, the petrodollar or a petrocurrency, that put additional pressure on the yuan and the yen, pushing those lower, making oil even more expensive. The Chinese had to intervene through their banking system to try and support the currency. That potentially brings more treasuries for sale. Maybe they sell short-term treasuries in the short run to relieve the pressure, and so it doesn't put that much pressure on the back end of the rates market. It's more perception than reality, but nonetheless, that was probably Janet Yellen's third best customer. Remember, her first was the Fed, second was the banks. We just talked about their lack of demand for treasuries. Third were foreigners, particularly countries that have export-driven models that try and keep their currency low to continue to drive exports, which means buying U.S. treasuries ultimately. So that's that doom loop. But the story for energy stocks themselves is getting better. So we're really hinting here at a tactical trade, being short banks and being long energy. And we think that's how you should be positioned, at least tactically for now. We then went on to talk a little bit about a preview for Jackson Hole. There's been some discussion about what's the real R-starred. Can we separate the short-term R-starred from the long-term R-starred? We expect to hear a lot about that. There is a giant dispersion in dots within the FOMC in 2025. The range was 5 3/4 to 2.5. Now that 5 3/4 may have been Bullard, who's no longer a member. Nonetheless, there's a big dispersion there. So there's a lot of debate within the Fed about what the true R-starred is. What's the equilibrium interest rate over time? We think we'll hear a lot about that. We don't think Powell is going to give up optionality, say that they're done, declare victory or anything like that. But again, those trends in how they're thinking about what's going to happen in 2024 are huge. Harkening back to John Williams' interview with the New York Times recently, he is on the side of still a very low R-starred, which would mean monetary policy is going to be getting increasingly tight as inflation comes down, that real rate rises, and the Williams faction that we think probably includes Goolsbee and Harker and a couple of others may be very well pushing for positioning for rate cuts in 2024. So something we'll hear more about at the FOMC in September, but maybe we'll get some foreshadowing of that at Jackson Hole. So finally, the question is, having hit our targets, is the risk-off episode done? Will this equity market bounce this morning hold? We think probably not. Now, we do get NVIDIA's earnings on Wednesday, and that may fire up the whole AI mania talk. It's not really completely a mania. That sounds pejorative. We do think it's a real factor that will contribute to productivity over time. But we think it's too early for the markets to have found their level. Fixed income is closer to our perception of fair value for now. And if we get soft labor market data, the bond market may very well bottom, in which case the stock market may find its level as well. But we think it'll probably be under a little more pressure here between now and next week's employment data. So not quite ready to declare victory on our little risk-off episode call and put some money to work. But if you were short, you might consider covering a few of those shorts. So that's it for me this week. Barry Neff from Ironsides Macro. Have a good week, everyone. Thank you.